Thank you so much for joining us today. At this time, all participants are in listen-only mode. As a reminder, to submit a question during the call, please click or tap on the Q&A tab on your screen. The information shared during this call is provided for educational purposes only and should not be considered an offer of services by Ellevest. This call is being recorded. Welcome, everyone. We're so glad you joined today's session, Investing 101 for Young Adults. The session really came out of, questions that we get from young adult clients, parents, people in our network telling us that, they want to start investing, but they feel intimidated or overwhelmed, or they feel like they should know everything before they dive in. So what we hope you'll walk away with from today's session's conversation is that that's not true. We'll cover the basics today. We'll get into literally the 101 of investing, starting at what is investing, what is risk, how do we think about different asset classes, what different account types are, everything that you need to know from a building block perspective, and some tangible things you can start doing today to grow your investments with a plan that we hope you can take with you and adapt as your life changes, your work changes, your income, and your goals evolve. So with that, let's start with some introductions. I'm Sara. I am a wealth advisor on the Ellevest team. I've been with the company now for 2.5 years. And before I joined Ellevest, I was with Goldman Sachs for the better part of a decade, investing for clients. I now live in Colorado, and really anything that has to do with a mountain is one of my favorite hobbies. So skiing, hiking, camping, biking in any season. Alondra, I'll pass to you.
Hello, everyone. I'm Alondra. I'm a senior portfolio manager here at Ellevest. I've been with the company for 4 years now, and I've been in wealth management my whole professional career. So a little over 13 years at this point. I started at Bank of America and also had experience with a Virginia-based RIA. And I am based in Florida. I really just enjoy being outside, working out, hanging out with my dogs. And that's a little bit about me. I'll pass it on to Kristen.
Hello, everyone. I'm Kristen. I'm also a portfolio manager here. Been in the industry for about a decade now. Started out at JP Morgan, but have been with Ellevest for about 6 years now. Similar to Sara, I'm also out in Colorado, but I am more of a summer sports kind of gal. So any sort of hiking, lakes sounds great. Skiing and snowboarding is not my thing. But that's a little bit about us.
We are going to break things all the way down to get started. So we'll start with the building blocks of, we'll start with understanding the basics. Then we'll get into building blocks of a portfolio. Then we'll talk about different account types that we should consider. Of course, we have to talk about the power of compounding because that's the magic of investing. And then we'll get into real steps that you can take away with you to get started today in your investing journey. So let's start with truly what is the definition of investing? Investing is when you use money to buy an investment. We'll talk about all different kinds of investment types with the goal that those dollars will gain value over time. Now, we know that with that goal that the investments will go up, there's also the chance that those investments will go down. So inherent in investing is taking on some kind of risk to hopefully gain some kind of return, which I'll touch on in a bit. When we think about investing, also what goes hand in hand with that is saving, right? What choices are you making with your dollars? Really, the key to that is when you're thinking about saving, you're thinking about shorter term cash needs, building up an emergency fund, thinking about upcoming short-term goals. And you want to build up that savings. Hopefully you're doing so in a high yield savings account where you can earn something on that cash, but you're really not expecting a higher return and you're not taking on a high risk level. The horizon that we think about for a savings account buildup is anything that's happening in 6 months to 2 years. You want to have savings for. Investing is when we think about putting dollars to work in various types of investments for the long haul. So longer term goals where you're really hoping that these dollars grow over time. We'll talk about all the different kinds of investments you can make, but the key difference here is that you're thinking longer term. You're taking on some level of risk to hopefully gain some level of return. So now I've said risk and return a few times, so let's talk about what those two things are. Really, at the heart of every investment, there's inherent risk and a hope for a return. So risk can come from a number of different ways, but really at the core of it, it's that the chance that the investment will go down. Risk can come from how volatile an investment is, how creditworthy an investment is, how long you're locking up your dollars for. All different factors can add to an investment risk. Return is the hope or the change in the investment's value. And again, the hope that that investment will go up, but the chance that it will go down. And the key relationship here between risk and return is that when you take on some level of risk, you hope to get an appropriate sized return. You never really want to take on outsized risk for less than what you would hope for in return. You want those two things to match. Now, when we think about putting a portfolio of investments together, we're thinking about risk and return alongside many other factors. So, Alondra, I'm going to pass to you and ask, where do we start when we construct a portfolio?
Awesome. So I will touch on the risk and return concept and bring that over to the portfolio construction part. And really the way we balance kind of like that risk return balance is by using diversification. So what is diversification? This means you're owning different asset classes, and these asset classes move differently from one another. So if you've ever heard the term, don't put all your eggs in one basket, this basically is what diversification is. You want to own things that react differently to the same news. And this is going to create or it's going to set you up for what we call asset allocation. So I'll dive into the asset allocation in a little bit, but I want to start with the major asset classes when constructing a portfolio. So in the same framework of risk and return, you can also think about your investments in terms of income and growth. And I'll start with bonds. So bonds are basically a loan that you give to a company or a government, and the characteristics of a bond are that it pays interest and then it gives you back your principal at the end of a certain time frame. So you're not taking on a huge risk because your return is really mostly going to be the interest payment that you get. Think about when you're lending money to a friend. If your friend is someone who is really responsible, has a job, has all these characteristics that make them a person that you feel comfortable lending to, that's a low risk loan. You can also make high risk loans. Maybe this is to your other friend who doesn't have a job right now, who kind of doesn't pay his bills on time. You can still make the loan. You would be better off charging them a higher interest rate, and there is still a chance that they might not pay you back. But at the end of the day, you're still expecting to receive either some interest or some portion of your money back. Stocks, on the other hand, are more on the growth side of the equation. Stocks are shares of ownership in a public company. So the value of your shares will vary as the stock moves up and down. You are participating in the growth of a company. So if a company is doing great, has great products, get great services, their revenue is increasing, their costs are coming down, and therefore their profit is going up, your share in the investment is going to do really well. It will appreciate over time. there are companies that can fail. And that is kind of like the risky side of stocks. So think about, again, income and growth. Your bonds are your income generating portion of the portfolio. Your stocks are your growth portion of the portfolio. And I did want to touch on alternatives. Alternatives are basically anything that's not a public stock or a public bond. You typically access these through private investments. So if you've ever heard of private equity, private credit, real estate investments, that's what an alternative is. And I won't spend too much time on it because right now, as young adults and when you're starting your investment journey, alternatives are not as essential as your building blocks, which are stocks and bonds. But alternatives can provide another layer of diversification and help reduce the overall risk of your portfolio by having access to kind of these more private opportunities. So I touched on asset allocation, and this is what we mean when we talk about asset allocation. As portfolio managers, this is like what we live by every single day. And it's basically having a mix of stocks, bonds, and alternatives. The mix is specific to your situation. So, without knowing much about the audience here necessarily, your particular situation, it's safe to say that as a young adult, you want to be primarily in stocks because when you're investing, you are investing for the long term. And if you're someone in your early 20s, you're starting your first job, you're you're in a great situation because the best friend for compounding is time. So when you have a long time horizon to invest, you can weather those fluctuations in the market better. Your investments can afford to go down when the market goes down because you don't need them right away. You can wait for the market to recover. And as you're investing continuously, you can also catch those lows and buy when the market is down. So this pie chart is just showing you all three asset classes. And for sake of the conversation, we have 60% in bonds, 30% in stocks, 10% in alternatives. But there's an additional layer of diversification here. So within your stocks, this is what I'm going to focus on. You can also diversify. How can you diversify within stocks? There are multiple ways. So if you think about just public stocks in the world, these are all the public companies that are out there. So you have stocks in the United States, you have stocks in Europe, in China, in India. And then you also have large companies, mid-sized companies, small companies. So within your stock allocation, you add a layer of diversification by buying little pieces of everything, right? You don't want to be, I'm sure people on this webinar have heard of the S&P 500, the largest 500 companies in the United States. That's great. They've done pretty well over the last 20 years. But guess what? There are over 3,000 companies out there. So you want to make sure that you're not inadvertently concentrated in one area of the market because maybe that's the part that's done really well over the past decade, but that doesn't mean that that trend will continue. And so you want to make sure you have exposure to international stocks that behave differently from like what's going on in the United States, that have a different currency, that have a different interest rate environment. And so by doing that, you are decreasing the overall risk of your portfolio and potentially enhancing your returns. Lastly, the question that I hear a lot is, okay, that sounds great. Stocks and bonds, I get it. Income growth. How do I buy these? And I will touch on these 5 major types of investments, but I will focus on the one that I recommend. So you can buy an individual stock or a bond. That just means you buy shares of Apple, you buy a Microsoft bond, and you just have exposure to that specific company that's issuing the stock or the bond. It's typically no fee to do this on your brokerage account, easy to do. You can trade it when the market's open. Then we have exchange traded funds. These are pools of money, so basically a basket of many investments, and it can be stocks or bonds, and they usually track an index. So an index, I mentioned the S&P 500 earlier, right? So that's an index of the largest 500 companies in the United States. There are indices for all the companies in emerging markets. So think about China and Brazil, Mexico. You can also find indices for just the small companies in the United States. So these baskets of investments are put together by a provider. So if you've ever heard of like Vanguard or BlackRock, those are some of the most prominent names in ETFs. You'll get access by buying shares into this ETF to all the underlying investments in that index. Also, typically low fee. You can also access that on your brokerage account. You get this kind of broad market exposure, and it's pretty easy to buy and sell during market hours. Then you have a mutual fund. So similar to an ETF, this is also a pool of money, but here you have a professional managing the investments. So it doesn't necessarily track an index. They may have more say into what they're buying, excluding certain companies, excluding certain bonds from the entire investable universe. These have a higher fee than ETFs usually, and that's because you're kind of paying for that active management. There are passive mutual funds, but I will say the benefit of ETFs over mutual funds is that ETFs trade throughout the day. You can see the value fluctuate, whereas a mutual fund prices only at the end of the day based on how the market closed. Then you have separately managed accounts, and these are personalized investment accounts where you own those individual holdings, whether that's stocks and bonds. These tend to be a little bit more expensive. There are good reasons to have them, but it's really not like where you want to start. And then lastly, you have private investments or fund of funds. So this is mostly when it comes to alternatives, this is how you would access those. But like I said, the exchange traded fund is what I would recommend as a young adult starting out. You're getting broad market exposure. You're not making any specific bets. You want to have that diversified exposure to stocks, diversified exposure to bonds. This is very fee efficient. To give you kind of context on fee, 3 basis points, which is 0.03%, is like a good low expense ratio fund. This is one of the most overlooked things sometimes, not just by new investors, but by sophisticated investors too. If you're paying more than, I would say, 50 basis points for a passive fund, it's going to eat up into your returns. So really pay attention to what that expense ratio is.
Great. So now we know all the different kinds of investments we can select. We know how to think about the mix of those types of investments, but where do we actually invest in those kinds of investment vehicles? So, Kristen, what are the different types of accounts we might consider, and what's unique about each of them?
Yeah, so there are a lot of different types of accounts out there, but at a high level, we can divide it into two different buckets. So taxable and tax advantaged. They're both used for investing, but they differ primarily in when and how the government taxes your money, when you can access those funds, and also how much you can contribute each year into those accounts. So, starting with the simple one, taxable accounts. These are commonly referred to as brokerage accounts. Even Alondra was using that term in her terminology. So, brokerage accounts, they are your pretty standard investment account. You can contribute and withdraw as much or as little as you would like, without limits. But as the name implies, they are taxable accounts. So you will pay taxes on your dividend payments, and you'll also pay taxes on securities you sell that have increased in value since you purchased them. But in general, these accounts are pretty flexible. Your goals drive the purpose of the account. So you can toggle up or toggle down the risk to meet your needs. And your needs are likely going to change over time. So your allocations, that mix of your stocks and bonds, will also likely change over time. The other category here is your tax advantage accounts. So you've likely heard of IRAs and 401ks. Those are two accounts that fall under this bucket. And I like to call this bucket your retirement bucket. So when you fund these accounts, you have to be comfortable with the fact that you are not meant to touch these funds for years, sometimes decades, depending on how old you are. I'm guessing most of the people on this call, it's going to be a decades timeline here. But IRA accounts you can open on your own. 401ks are commonly offered through your employer. But for each of these, there are two different subcategories that I think are worth highlighting here. So traditional and Roth. Traditional IRAs and 401ks are funded with pre-tax money. They grow tax deferred, and then you pay taxes when you withdraw the funds in retirement. So there's that delayed tax benefit that lets your contributions grow and grow until you're ready to use those funds. Roth IRAs and 401ks have the opposite tax timeline. So they're funded with post-tax money. They grow tax-free, and then you can withdraw tax-free since you already paid taxes when you made those contributions. So those I would say are the common buckets or account types that you should be aware of. And you might be asking, like, how do I choose between these two, Roth versus traditional? Um, I would say that everyone's situation is different, but generally speaking, I think that Roths are a really great option for young folks starting out, because although it hurts to pay taxes now, no one likes taxes. It is very likely that you are in a lower tax rate now, than you will be in the future once you've, grown your career, you're making more money, and you're more likely to be in a higher tax bracket. Um, and secondly, without getting into too many nuances, there is an income limit for contributing to a Roth IRA, and very often younger folks are under that income limit. So whenever I talk to friends and families, I usually emphasize taking advantage of a Roth IRA or a Roth 401k if your company offers one, and then moving to traditional when your income level grows and if you need to set aside more retirement. Either way, though, both accounts are really, really great options for growing that retirement bucket. The choice really comes down to personal preference.
Awesome. Super helpful. I feel like we hear all the time, start investing early, stay invested for the long haul. Kristen, why is it so important, those two grounding investment philosophies?
Yes, starting early is super, super important. Very simply put, time is your best friend in investing. And there is a widely used term in the industry called compounding. We have a very fancy definition here. But in more layman's terms, it's the idea of earning on your previous earnings. And for those who are visual learners, I really like the snowball analogy. So think of a small snowball rolling down a hill, and as it rolls, it picks up snow, it gets bigger, and on every roll, it collects even more snow, right? So investing also has that snowball effect. Your money earns returns not just on that initial investment that you put in the account, but it also earns on those accumulated returns from previous years. So that concept as a whole is known as compounding returns. So there are many ways, many charts out there to show just how important time in the market is, but we chose two different graphs that I will walk you through. So the first one here is shows how important starting early is. So the bottom axis of the chart shows the age at which you make a $1,000 investment. And the left axis shows the value of that $1,000 when you're 65. And each of the colored lines shows a different return assumption. Truthfully, the return numbers here matter less than the general story that the lines tell. But looking at the far left, and let's use the top line just to keep it easy on our eyes. If you invest $1,000 at the age of 25 and the market does really well for the next 40 years, that $1,000 could be worth over $14,000 when you're 65. And this assumes that you do absolutely nothing once you invest that $1,000. You just sit back and let time do its thing. If you wait until you're 35 to make that first $1,000 investment, it could grow to about $8,000 when you're 65. So still a return, but waiting just those 10 years costs you about $6,000, or if you're thinking in terms of like percentage, it nearly cuts the future value in half. So I'm a bit of a nerd, but I love this graph because it not only shows the power of compounding over time, but it also shows how you don't need to set aside a lot of money now to have pretty sizable wealth in the future. And like, I get it when you're young, like I'm also still young, right? I'm in my 30s. Retirement feels so far away. It is hard to be disciplined and to set funds aside, but I do hope that you can see from this chart that just how important it is to start setting aside money, even if it is small amounts as early as you can, because time really is your best friend. The next slide that we will walk through is it speaks to why it's important to stay invested, despite how rocky things may, and truly ultimately will at some point feel. So, say you invest $100,000 in the early 2000s. Things are initially going really well. You're seeing your account value increase. And then things get rocky in the late 2000s, and you see the value of your account start to decrease. So, that light shaded area there. There are three different scenarios played out here. So, say you get really spooked and you sell out of everything and you just keep holding cash until now. That account is worth about $200,000 now. So, that bottom line. In the middle scenario, you get spooked and you sell everything and you hold cash for just 1 year before reinvesting again. That account is now worth $600,000. So better than just cash. But if you did not or if you did not touch your account and you just let it ride the ups and downs of the roller coaster, and you see that there are more ups and downs during this time period, which is very typical in investing, there will be ups and downs. Your account would now be worth over $1 million. So this is all to say, there will be times when it feels scary to invest. There will be times when the market goes down. I don't know how long those time periods will be or when they'll be, but I can guarantee the market will fall to some extent at some point. And it's hard, but it's also very important to stay the course because trading on emotions can be very costly, as you see here. So personally, just a little anecdote, like when the markets are having a rough period, that is when I turn my head and I stop looking at my account balances because sometimes you just need to trust the process a little bit.
I'd also say one of the most fun mind games about investing is that when the market feels the worst, it's oftentimes the best time to put money to work. So
Yeah.
you have to work your brain a little bit.
Yes.
Okay, so we've spent a good amount of time in class so far. And maybe one of the bigger takeaways is, so far is to start early. So let's think about that. If I'm just beginning in my career, or I'm at a point where I'm earning some real income for the first time, or I'm just starting to think about building my investments now, what should I do? Where should I go to get started? We laid out kind of four different large categories to break this down. I'm going to start left to right, and we're going to share our personal missteps or how we think about this as we go through this slide. But, I'll say the first part of this journey is to just know what you own. So take an inventory of your personal balance sheet, right? What do you have in checking accounts today? What do you have in savings accounts today? What CDs might you have, in some random login that you've forgotten by now? Are those set to auto renew? And should we turn those off? Do you have a 401k that your company is offering that you are or are not contributing to? Do you have IRAs that perhaps your parents set up as custodial Roth IRAs when you were younger that you now have access to? Do you have brokerage accounts? So, full inventory of understanding what you already have and then understanding what your cash flow is, right? What's coming in? What are your fixed and variable expenses? A little bit of budgeting here. So, you really get a handle on what is available to start thinking about investing if you're not doing that today. So we think about clarifying goals. Alondra, I might pass to you first. How much do you need to think about? How do you think about an emergency fund? And then how do you think about any excess that you can start investing each month? Or how did you think about that when you first started out?
So, I think it's really important to your point earlier during the educational piece of this webinar. Um, there's the savings part and there's the investment part. And so, how much do you need in an emergency fund is going to be very specific to you. There are various guidelines out there. It's like 6 months of your salary or like 6 months of rent. At the end of the day, it's an amount that you think will cover any emergencies, short-term emergencies, or if you were to lose your job, like you have a way to make things work. And maybe even a little bit more if that just makes you sleep at night better and not touch your investment account. That's kind of how I think about the emotional side too of having a large enough like save emergency fund that you let the investing do the investing. It goes hand in hand with your budgeting. I personally love budgeting. I tell everyone that will listen to download an app, categorize all your expenses. I track absolutely everything. My husband's a little annoyed because we go over this, like, what was that $60 credit card for? But it really gives me an idea of how much money is coming in, how much money is absolutely accounted for, like what's my rent, how much am I spending to eat, and then what's variable, like can I afford the extra subscription to whatever this month. And that's going to determine what that's going to give you a better idea of like how much do you need to have in your emergency fund, because you are going to have a good handle on how much you actually spend every month on things that are absolutely fixed and things that are variable but like that you still can't completely cut out.
What's your favorite budgeting app? What do you use?
I use Copilot. I don't have a promo code, so I'm going to ask them to sponsor me or something.
Awesome. And then a big one here that we have is seeing if your employer offers a 401k match. So we've talked a little bit about the power of thinking about retirement and socking some dollars away. I think perhaps for us all, the first priority that we would think about if we're just starting out and you have a little bit that you can afford to put towards investments every month, start off with a 401k if your employer offers it, especially if there's an employer match, right? It's kind of free money that's coming to you to be socked away for retirement. Um, but as you're taking inventory and you perhaps have debt to pay off and you're also thinking about investing, Kristen, how do you weigh those priorities? What do you kind of want to tackle first?
Yeah, I think that there's a balance for everyone, and that balance is going to be different for everyone. But I do think that there is an opportunity cost, right? Of like you have to decide where your funds go. It could be in your emergency account, it could be spending every month, right? But there's also the real possibility that you have debt on your balance sheet, whether it's student loans, a car payment, the list goes on. And some of those interest rates, especially if they're relatively new loans, could be pretty high, 6, 7, 8, 9% we've seen. Um, and there's that opportunity cost of, do I keep that 6, 7, 8, 9% loan outstanding, or do I direct funds into an investment account that I hope will earn more than that return. Um, I would say, and again, the answer is going to vary for every person, but generally speaking, I do think it's a good practice to start chipping away at those higher interest rate loans. So kind of sort out from, highest to lowest rate and start with that higher rate, potentially before you start investing too, because that is just money that is just bleeding from your wallet every month or every quarter, depending on those payments. And I think that one more comment, just going back to your second bullet point of your 401k, as I talked about, I love the retirement account bucket. I think that one misconception in investing is that you need to own a lot of different things. And like you really don't like it is okay for investing to feel boring and to keep it simple. And sometimes simple is better. So very often in a 401k, when you log in, if your company does offer one, you'll have a whole investment menu of vehicles that you can buy, investment options that you can buy into. Um, I would say don't feel like you need to pick four, five, six different line items. Like sometimes choosing a one line target date fund is your best option. It's clean, it's simple, it will automatically de-risk as you get older. So just my little tidbit of like sometimes boring is a good thing in investment accounts.
Mhm. I think that's the perfect segue into risk tolerance. So, when you're thinking about your goals, you're thinking about time horizon. We talked a lot about, especially if you're younger and you're just starting out, you have a longer time horizon in theory to grow these accounts. So, where do you start when you think about risk and what amounts you're comfortable taking on in investment accounts? And one thing you just said, Kristen, made me think about, we've talked about different types of accounts, taxable, brokerage, and retirement accounts. You might think about risk in those accounts differently, right? You might have a longer time horizon for retirement accounts. You might be more comfortable taking on longer dated risk there than you are in your brokerage account. Or you might like to pick stocks in your brokerage account, and that might be a fun carve out that you do. That's taking on more risk, right? You might want your investment, your retirement accounts to kind of be middle of the road growth. So you can think about risk in a lot of different ways. How do you both break it down for your own investments?
Well, I think that there's also kind of subcategory to this topic too, of like ability to take risk, but also your willingness to take risk, which comes down to like the personal, emotional side of things. Like if you're just looking at the facts that someone's really young, they're, just out of school, they're getting their paychecks, it's a pretty steady paycheck, you might look at that and say, great, they have a really long time horizon, they can afford to take a lot of risks, so they can invest in a lot of stocks that will be up and down, but over time, by the time they need those funds, will hopefully be up. Even if someone is in that situation, they might not be able to stomach the ups and downs of that. So we work with clients all the time, right? That are, if you're looking at the facts, we'd say have them in 90% equities or stocks. But there is that balance between your ability to take risk and also someone's willingness. So I think that comes down to like a little personal like question to yourself before you start investing.
And I think that this is one of those things that sometimes makes people take a step back and not do that first investment, right? Like we have talked a lot about the fact that we can guarantee the market is going to go down at some point. And so some folks may be like, well, I don't want my money to lose value, which is a very normal thing to not want to happen. So usually like I'll tell my friends when they're starting to invest, I'm like, look, just buy $100 and just give yourself a little bit of time so you can log into your account and just see the market value go up and down. And then they're like, oh, okay, yeah, like it's going up. I'll put another $100 because it feels good to make money. So then they put more money in, and then the market drops like 10%, and they're like, oh my God, they call me. What do I do? I'm like, buy a little bit more. And they're hesitant, but they do it. And then 3 months down the road, maybe it's up again. to the point where now I have those friends texting me like, "Hey, I saw this thing about like these stocks," because now you're kind of learning by doing and you have a better sense for like we can tell you all day long statistics about the market, how much it goes down, how much it goes up, what's a correction, what's a bear market, but there's nothing like actually feeling it yourself. And so when you're starting out, I think dipping your toes and get a feel for that, emotional side. And then you can start moving closer, moving your willingness to take risks closer to your ability to take risks. I think the 401ks are a great example of an account where you're just like structurally limited to like you can't touch it. So you kind of just, a lot of people also don't log in every day or every quarter to see their 401k, so it helps not have that like top of mind and front and center. But usually with like a taxable account, a brokerage account where you can access your money, you can sell and literally withdraw it. There tends to be a little more of that emotional conflict.
Yeah, yeah, absolutely. So the final piece here is to do a lot of what we've been saying. So either on your own or with an advisor, open an account, right? You just open one of these accounts, either a brokerage account, an IRA if you don't have one, start contributing to your 401k, think about low cost index funds, stay disciplined, right? Set up that recurring contribution so that you don't talk yourself out of contributing or you don't forget to contribute. You just kind of do it on a monthly basis. Um, we have a next slide of common mistakes that, Alondra, I might have you just pull up, but I want to, and I think we've touched on a lot of these throughout. I think they're very important, but I want to use the last few minutes that we have to answer some of the Q&As that came in. If we don't get to all of them, we'll certainly follow up in a follow-up email with some of this information and more questions. But we love all the questions that are coming in, so keep sending. So we've talked a lot about 401k, so this one's interesting. If you leave a job and won't have an income for a while, what should you do with the 401k you previously had at the job? I think we see this a lot with people that have left jobs or changed careers multiple times. You have kind of old 401ks. Typically, most of the time, those assets are still invested in whatever they were when you left that job. So it's not just cash sitting there, which is good, but you can also consolidate your world of investment accounts so that you don't end up, 20 years into a career where you have five different 401k accounts out there. You can roll them into what's called a rollover IRA. And you can do that as many times as you have, a 401k that you've left a job for. The thing you want to think about is when you initiate that rollover process, doing that in a seamless, quick manner so that those dollars aren't kind of out there in cash once you initiate that process, you'll sell the investments in your 401k that will then be sitting in cash. You want to get that into a rollover IRA quickly so that you can reinvest it, right? You never want retirement dollars just in cash. But that's one thing to think about as a cleanup in your life. This one I'll throw to you ladies. I think it's a great one. What are the main differences you see between women and men in relation to their attitude in investing?
Oh, I love this question. I'll start and then I won't take too long so Kristen can share her opinion too. So what we have found through our experience is that women tend to be labeled very risk averse. They don't want to invest. They're afraid of losing money. And I think one of the things that we have learned through just our female clients is that they're not risk averse, they are risk aware. And that makes perfect sense. Women typically are the CFOs of their household. So they have a really good understanding of what's coming in, what's leaving, how much are the groceries, like how much is gas changing on a month to month basis. So they want to make sure that they have all the information before they make an investment. And that's where I think the our call to action is like just do it, just invest, just start investing, get a feel for it. You don't have to have all the facts. It's good to be risk aware, but you also have to kind of just just do it sometimes and trust the process, like Kristen said. Um, Men typically are more focused on a return number. I'll let Kristen touch on this because that's also another difference of like how we see women think about their goals versus men.
Kristen,
Um,
jump in quickly.
yeah, so sorry, I was thinking we were wrapping up here, but we'll chime in quickly. So yeah, I would say too that women, once they are invested, tend to be better, stickier investors too. And they're more willing to take that risk, so that higher return number than we see um, the men, because even though generally speaking, women are known to be a little bit more on the emotional side of the spectrum, um, we tend to be more disciplined investors when you're looking at the long term. Like we can stomach those ups and downs, shockingly, right? We can stomach those ups and downs and a little bit better than men, which ultimately leads to greater returns in the long term.
The three of us could talk about this
We
literally all
could.
day. I wish we had, 10 more minutes to get to all the questions, but we will get to all of them in our follow-up. So if you sent a question in, check your email tomorrow. You'll see them all. There we will share this recording in the follow-up as well if you want to go back through the slides. And if you have any other detailed questions that you didn't get to submit, reach out to one of us or your Ellevest contact. We are always happy to talk about investing 101. But with that, thank you all so much for joining us today. It was a great conversation and we had a ton of fun chatting with each other. Bye, everyone.
Everyone for joining.
Thanks, everyone.